Financial mobility. It is a big question, basically, and also, especially when we are looking to the East Asian development model, the views which basically state that financial mobility might not be always that much beneficial. Uh, and basically, when you go back to 1990s, the viewpoint was pretty much different. Um, and the main idea was the more mobile is your country for financial funds. I mean, it will attract more funds, and those funds, I mean, sometimes may remain for the long run, sometimes for the short run, but anyway, those funds will be available for the investments in your country. So that's something desirable. Um, but then, um, again, the first thing was uh, short-term uh, uh, financial funds that are coming in mass for short run, staying in your country and going out. Well, even in some cases, when they go out in 1 or 2 years, it might be too little. They might be hesitate for too little time. Basically, they might not create a basis for the investment, especially they might prevent your country's companies to take loans from outside countries because uh, the funds that are getting in and out create financial instability. And that's instability means when your country's money goes up, then that will scare the people who are the value of the value of your the money the value of your money goes up. In that case, I mean, it scares the companies which need to pay in your currency, make payments in your currency. Well, that's because if they especially using dollar, in that case, their dollar worth less in your currency, and it might also discourage people who might basically receive dollar payment to spend in your country. And if the value of your currency goes up, then basically the people who got um, payments in your currency and who got payments in your currency and who need to make payments in dollar might be scared because I mean in that case the amount they need to pay will be more or the international value of what they get will be less. So fluctuations are discouraging financial integration. I mean, it damages financial integration, and maybe too much financial mobility might creating fluctuations and basically some uncontrolled capital moves in and out. But that in and out mobility might be stripping your country's companies' ability to get foreign funds. Um, Of course, the one question might be whether basically this financial mobility is a tool to discipline the economy. I mean, maybe to stabilize the funds availability in the country. I mean, to get more funds, the countries might basically create a reliable financial system and uh, they might apply policies to keep their exchange rate as stable as possible. And all of those things might also benefit international integration in other ways around. I mean, uh, without this funds coming in and out, maybe the country might be reluctant to keep exchange rate constant. But now, this financial capital inflow factor might be actually disciplining the country and enforce country to, I mean, to create a financial system with discipline, basically, uh, where I mean the monetary value of the value of your money remains relatively stable. Of course, uh, one idea is too much financial mobility, especially in developing countries, might not get you the funds you need. It might even make the funds that exist in your country, your local funds, to go out and invest rather in foreign countries. And you might have heard in Turkey, for example, there were discussions on politicians, even politicians who take their funds money out of the country, and those questions are also asked for some businessmen in some cases. And the next discussion, actually, the last discussion of this topic will be kind of on it. As I said, even in developed countries, this is a discussion. I mean, outflow of financial capital from your country. I mean, to certain centers which are not necessarily even developed countries. So, is financial mobility creating that? I mean, is it just draining countries from the financial funds? And basically, I mean, getting financial funds out of the control of the national, I mean, institutions, including, I mean, not state institutions, but the institutions in most of the countries, except few centers which become global financial centers. This is a big question. I mean, big question. And if now the financial capital is getting centered in certain small global financial centers, what does it mean for the world is another big question. I mean, if you can access to these funds, this might not be necessarily that bad, but can you access to these funds? So all of these questions basically come together on and merge into one big question, which is financial mobility really good? Should it be restricted to some extent? Well, I have already talked on the stability and mobility question. I mean, if you that's one idea. If you have have too much financial funds going in and out of your country in mass, this might basically destroy the stability in your country. And if you have not that much stability, even if large capital is coming into your country and going out, financial capital, I mean, still the country might be unpleasant place for the long-term investments. But if mobility is not there, in that case, the long-term investments might still not come in, because they might fear that they might not be able to take out their capital. So, according to a view, you should have a balance between the stability and mobility. What should be the balance exactly? I mean, and how should capital long-term the capital that comes for long-term investments, or at least as financial capital remains for long-term, is encouraged in most efficient ways? This is a big question. This is a big question. And countries that are making this successfully, East Asian countries, those are the countries maybe that should be looked upon. They have severe, actually, capital control measures, but still companies are coming to those countries. Maybe to some extent, I mean, if you provide certain benefits in the country, if you provide certain freedoms in your country, cheap labor force, low production costs, this relative restrictions on the mobility might not be something those companies are not that much caring for. And if that's the case, in that case, you rather provide a more stable environment. I mean, the stability might be much more heavier than mobility. In that case, I mean, you move this to the mobility side more. So where this should actually stand is a big question. And here also the question becomes the desirability of what is called PI, or the portfolio investments. Well, FDI those terms can be taught as two different types of investment. FDI is a type of investment which comes to your country to make actual physical investment, like building a factory, even building a bank, building a hotel, building a fast food chain restaurant. Of course, building a fast food chain restaurant should be done by the company itself. Sometimes the companies just give franchise, which means they just the local investors build the restaurant, but they just pay to the original restaurant for the right to put McDonald's, for example, in front of their restaurant. It is FDI if the McDonald's itself comes and invests in your country. FPI, on the other hand, is just financial capital, money coming to your country and banks of your country, which at first look, as I said, is not that bad because that money can be used by your local investors. But of course, it can only be used if it is stable and if it is moving too fast in and out. In that case, I mean, its usefulness for reliable long-term investments, which takes 1 year, 2 year, 3 year periods maybe to pay off, might be limited. So while FDI itself is also the type of investment on which there are some discussions. I mean, on its face value, I mean, it's not bad the foreign capital comes to your country and invests. But the process through which it comes to your country, process of making the country desirable, might create some problems according to some economists. We will come to that. But more economists are certainly in favor of FDI than FPI, foreign portfolio investments. Foreign portfolio investments, especially when they are short term, as I said before, for the reasons I mentioned, they can be, they are taken as, in some cases, harmful for the economic systems, national economic systems. I should mention one last option. It's a simple option relatively compared with the more drastic measures to control capital. It's the Tobin tax. Tobin tax is the case when which is a transaction tax. It might be like whenever your the financial capital comes to your country, leaves your country, it needs to pay a certain level of tax, which decreases the capital mobility now because the existing your country is costly. But this tax might not be that much of a deal if the FPI is planning to stay in your country for a long time. If the FPI comes to your country and is planning to stay for 10 years in your country, which it might even move between the different options in your country, they might not necessarily pay this tax. Although it might also be possible that, I mean, even the investments done on a certain company, a certain stock might, in each case, when you sell the stock, you might need to pay the money. In that case, I mean, the investment you make on that stock itself should be also a long-term investment. But you pay a lot of Tobin tax, especially you move in and out if you a lot of times, because each time you're out, you pay a new Tobin tax. Each time you're out, you pay a new Tobin tax. Well, even though it decreases the financial mobility, it is, according to, the idea, this type of tax is actually, its effect is negligible for the long-term financial investors, and it is just it just creates a significant let's say, decrease in mobility for the short-term investments. But if the country is rather want to get long-term investments, but not short-term investments, then Tobin tax might be just preventing, let's say, wrong type of investors and allowing right type of investments in your country, according to definitions made by taking long-term investors as the right type of investors. Well, next time I will start talking on the offshore banking.